kind of volatility choke point that we had discussed before, and it'll continuously come up periodically because, we had this idea that volatility eventually comes to this lower bound. So let's start with this idea of realized volatility. If we look at this historical chart of realized volatility, what I really want to focus is on green. Green is 1 month implied volatility. So what has the S&P 500 been doing over the last 1 month? What is the historical volatility or actual volatility? And what you can very clearly see here is there's this sawtooth pattern to volatility, right? Now, 2017 is the anomaly of anomalies here, and we've talked about it recently in a few of our notes, because if you look at volatility right here, here's August, right, of 2017, you can see the green line and the 5-day volatility, that kind of spikes up a little bit. That's kind of where we are now. And then what you see is that volatility eventually comes crushing down into October. October, I believe, is the lowest 1 month realized volatility metric ever. We hit in the threes. Nothing was going on back then. If you remember, this is when Trump was like very pro market and talking about how great the stock market was doing. And eventually what happens is we hit that level, we kind of skate along that level, and that leads to Volmageddon. So what you see here in this sawtooth pattern is that the pop in August volatility raised volatility enough so that there was a lot to sell. And I think that drew out larger volatility sellers that could really finally flush the S&P implied vol and realized vol to new lows in October. So you see that sawtooth pattern here. Then this is Volmageddon. Then you get this same, it's like an echo effect. And I've talked about this before. You can see this pattern here, right? And the pattern, goes over some different time frames. That's not a very good arrow, but you kind of get what I'm saying here, right? There's this pattern where you get these rolling wedges. If you're really into technical analysis, you know what I mean here, right? Where you press up against this lower bound. And if you look at that May volatility, I'm sorry how bad this drawings are, but you kind of hopefully are getting the ideas here. In that you get this rolling metric, call it an echo or you call it a falling wedge pattern or whatever it is. And people will always say, don't do technical analysis on volatility or the VIX or whatever. And by and large, I agree with that. I don't know if you want to do DeMark indicators and things like that necessarily, but the point is that there are these lower bounds to volatility where how much smaller can daily ranges get than 50 basis points in all reality? Like at some point you have a little bit of drift, a little bit of market movement, somebody comes in and buys a little bit, somebody comes in and sells a little bit, and then suddenly you're outside of that 50 bips daily range, right? Without much going on, and that can force cover traders, right? If you're betting on only 50 basis points of movement every day over the next, you're going to be wrong one day on that, right? Now, hopefully you get out of the way on that, but this kind of like, let's just call it 50 bips of low is what this range is, that bottom of the wedge that you're pushing against. And so again, you can see this consistently where the echo of volatility, so to speak, continues to press and press and press and press. And now we're getting into, this area again where the implied move is, 9% in daily options right now. Our implied move that we've talked about a bunch here is really rather low. Now I got multiple pens going on, so I can delete some of those. So the point here is that in my view, we're now hitting this point, right? Where what are you making by betting on lower volatility at this point? You're hoping that implied volatility goes from 9 to a 6, that if you're betting on implied volatility going for a 10 to an 11 to a 10 or 10 to 9, what are you really going to make from that, right? Now, if the VIX is up, let's say 20, and you're betting on going to 15, well, there's arguably a lot more reward in betting that you're going to get that mean reverting action. But right now, what you're really betting on is realized volatility going down, right? This green line going down, which then you would say, okay, now implied volatility of 11 is rich because realized volatility is now gone from a 10 or 9 to a 6. Now there's 5 points of kind of volatility premium in there that I can extract, right? That I can kind of pull out. And I just don't think that this is a great moment for that. So if we zoom in on volatility here, right? 1 month volatility is an 11. The lowest, as you can see, going into August, it was an 8, which is really quite low. 5 month volatility or 5-day volatility, that rolling metric has really come down. So all the points and the reasons why we think that implied volatility is going to pop here is because we're going to lose all of this gamma. Our argument is it's this gamma, right, in the S&P and these other indices that is helping to squash volatility. And that shows up in our models when you look at The founder's note, obviously, where we're projecting 53 basis points of daily implied volatility. This is about as low as I've ever seen it. I got to go back and check the data, but if there is a lower number, we're talking, 51 or something like that. After OPEX goes through, this number should be 75 to 100 basis points. I would think at least over 100, over 1% or 100 bips, probably not, but this number is going to expand. It can't really go lower at this point. It's at the lower bound. So the question is the market betting on, or does the market realize that the positioning that is suppressing volatility, does the market price in the fact that that is changing, right? Because you not only have the S&P, the NASDAQ, all that gamma going away, you have the VIX expiration, which should reduce a lot of the pressure pushing the VIX lower. Then you have the FOMC trigger. So the FOMC trigger is going into these big positions, as you can see right here around 4,500. It's even bigger in the spiders, right? This gamma is going away. And so now the market should be freer to move. Our daily range is going to expand because of that. The Fed is going to come in and say, whatever it is they say, bullish or bearish, it doesn't really matter. The market is going to be poised to move. And so that is the key insight here that we think we can identify in our edges in this positional assessment that the market may not be appropriately pricing in our view, of course. Now, what happens is after we have all this gamma is going to get reduced, right? Cut down. We then start to look at this area up here, which is where the end of month JP Morgan strike is, right? At 4660 is roughly there. So that's my sloppy writing. We'll just call it 4650. And then to the downside, they're down, the long put that they own is down here at 4500. So this is, particularly the downside, this is a lot of distance, right? Now to the upside, we're only 2 points away. And so the Fed is going to come out and they're going to say, hey, look, either market, you guys are pricing things correctly, right? In which case you can say, hey, that means implied volatility should come down. So if we just flip over to the implied vol dashboard here, we can either say, hey, you guys are right, and this is the kind of event volatility that's being priced in, right? This little bump here. You guys are right, or it's even better than you think. We're not going to raise, for sure, we're done. Either of those scenarios, this implied volatility, event volatility that's here is going to fall back in line. That's a tailwind for markets, as it was for CPI, as we outlined in the notes. That's going to help to boost equity prices, right, in the very short term. If that happens, then you got to suddenly start to look at this upside strike in this 4660 trade, which is the JP Morgan area of the market, which suddenly, when we're sitting at 4,500, you go, well, that's not crazy. A 2% rally by September 29th, that's not that wild. And the farther that we go up towards that strike, right, the farther we get into the area of this strike, the more the gamma of this strike picks up, right? The delta of this option is currently like a 5 to 10, I think. And so if we suddenly pop to here, well, this delta, the delta of this option is going to grow quite a bit. And that is going to be like a sucking, so they're going to like this pole or this magnet that helps to pull us up into this area. So you get the implied volatility, the event volatility is going to come down. And once that comes down, then that Vanna tailwind can kick in that artificially, or not artificially, but that leads to delta hedging flows that can pull the market up. And then this 4665 position can catch and help us pull all the way up, right? So step one is gamma gets cleared. Step two is the event volatility comes down, and that helps to boost the market up. It has less resistance now because that gamma is gone. And then step three is the gamma of this position grows if we start to get into the area of that strike. And that is why we've been recommending the end of month 4,600 area call. 4,550, was a specific number that we put out in our founder's note. That is the upside scenario. And that upside scenario only exists in the end of month. After that, we have no reason to think that the market could go higher or shorter. We don't have a really good view there, right? This is a view that's a strong view into the end of the month. Now, this is, of course, dependent on the Fed. So the situation two, or the second side of the coin, is the Fed comes out and says, look, CPI was hotter, or whatever it is, right? And you guys are wrong about forward guidance. We got to hike again, or some other word that they change that makes volatility go up. At which point you have this short dated vol is going to flatten out, right? So here you'd suddenly get 12, 13, 14 percent longer dated vol. Right now, this is all 11%, is very low. You could end up with a backwardated curve, flat to backwardated curve, in which case people are going to start covering any kind of short volatility trade that I have on, and possibly looking to get long some puts, right? That could lead to a volatility jump. And in that sort of scenario, just as we were we were framing the upside, then you start to look and you say, okay, well, what's the downside scenario there? Again, we're going to clear out all of the at the money gamma, all of this volatility suppressing positions, right? Those are all going away. Volatility is not going to spike, and dealers are going to have to start selling futures, and that downside pressure is going to build. Now that JP Morgan put position is way down here at 42.50. That's a hefty drop from here. So, I don't know that I necessarily want to target that, but our put wall is here. That's going to go away with expiration. You can start to really look at this 4,300 area as an end of month situation, because you get a volatility jump, right? VIX is going to move to the 20s probably in that scenario. And you get these reflexive feedback loops of volatility pressing lower. And the same thing with the upside position. The downside position, this JP Morgan trade, that put will pick up, and there's 50,000 or 45,000 puts there that could start to spool up in value, and you get that pressure to the downside, right? This is why we recommended a December, something like a 5% out of the money December put, because number one, if you're getting long the option at 14, 15% implied vol, which is what we talked about in our notes, if vol gets crushed a little bit more, you're not really getting hit that hard, arguably, in that view, because vol is just going from 15. That option maybe goes to a 13. Like, it's not going to go to a 10, I don't think. You may lose a little bit on the deltas, right, because the market rallies. But that's why we would like this shorter dated call, which would offset any type of a rally there, right? So that is the outline of what could happen over FOMC, or over the next couple of days to FOMC. Now, pre-FOMC, the short dated people have the market where they want them, right? Because nothing is going to happen on tomorrow that should really move the market a whole lot, right? Nothing's going to happen on Monday. Nothing's going to happen on Tuesday. And if anything, the VIX expiration, maybe it's a little bit of a tailwind, arguably, for the market. So the market is well supported and doesn't have a reason to go down over the next couple of days. So the short dated vol sellers can come out and play their short dated vol selling games over the next couple of days. And we could get this upside drift to continue as it is in its current form, which is why we said, hey, if you want to play this OPEX positioning, do it before CPI, because then you get the advantage of this upside drift that may come. And then into FOMC, you could hedge off your position, right? If you got long the 45.50 calls and the market drifted up, great. Sell the 46.60 calls if you can get them for a decent price, or turn your long call into a call spread. The single leg, going into it with the single leg, gave you some optionality. And you want to maintain that put, because while people think the Fed shouldn't do anything now, and CPI kind of bolsters that, you really don't know until the event comes out itself, right? So that's kind of what the issue is now. We've kind of cleared the bigger risk. There's nothing to really start the upside drift or continue this upside drift, and that drift really maintains its strength if we hold that 4,500 level in our view. So that's how we're looking at things from an OPEX perspective.